Hello there. It's been an absolute scorcher here in London this week, and it's not just the temperatures that have been soaring. And talking of the weather, ECB President Mario Draghi, he greeted the markets this week and said that Europe's financial markets have weathered the uncertainty caused by Britain's vote to leave the EU, adding that the markets have displayed courage and resilience. Well, let's go through all of the events that could potentially derail that resilience, beginning with the economic events. Now, it's a big week for Japan because there's plenty of speculation that the government will pump up its stimulus measures to drag the economy out of its deflationary hole. We've also got German data to come on Monday, as well as the UK industrial trends too. On Tuesday, we've got more from Germany with those retail sales, the UK's mortgage approvals and US new home sales. On Wednesday, we start in Australia for the inflation rate, Germany consumer confidence, France consumer confidence, UK GDP, US durable goods orders. We've got some crude oil numbers to look at as well, and that all-important Fed interest rate decision. On Thursday, we start with Germany, the unemployment rate, inflation rate as well, and the EU business confidence, as well as jobs numbers from the US and consumer confidence as well. On Friday, we finish up in Japan. This is probably the most important event of the week. It's the Bank of Japan's interest rate decision. We've also got production, unemployment stats from Japan. We've also got GDP from France, unemployment from the eurozone, GDP from the US, and consumer sentiment as well. Okay, so there's some key events coming up next week, and we're going to talk about three of them that have caught our eye. We've got Chris Beecham right here to discuss all of these in detail. Hello, G. Welcome, as usual. And here they are. Okay, the UK, there we are. We're going to talk about that GDP number. So the IMF has already slashed the forecast for the UK growth, blaming the Brexit for that. It's still going to be higher than other countries, but it's still worrying stuff, isn't it, this come down?
Yeah, it will be quite interesting to watch what we get from the second quarter numbers. Now, remember, this does include the period leading up to the Brexit vote at the end of June, but it's only the very end. So it will be hard, I think, to read too much into what we're seeing from the UK for these numbers. And of course, remember, these are the preliminary figures. We only have about a third of the total data available for these numbers. So we can expect them to be quite a bit revised as we head into the rest of the third quarter when further revisions come out. But what we've had this week has been a lot of UK data. But today, with that manufacturing services PMI reading both dropping, it has weakened the pound against the US dollar. We're heading back towards that 130 level, and you can see on the chart there we're still really in this range we've had for the pound against the US dollar since the Brexit vote. Indeed, we've been sort of bouncing around 130 against the dollar for about the past 2 or 3 weeks, and that's just continued this trend. Now, the pound has moved lower, not just because of uncertainty about Brexit, but also because today's PMI numbers really suggest that the Bank of England will cut rates in August, which is the big event, only a couple of weeks away, actually, really, so not too long to go. So GDP numbers will be very interesting to watch out for, but I think we should be a bit more cautious before we suggest that it's really all down to what happened in June.
OK, well, let's stick with GDP numbers, because next on the list, we have got the eurozone GDP to talk about, and this is also expected to drop.
Yeah, and a further weakness for the eurozone. We had PMI numbers this morning from the eurozone, which were actually better than expected. So that has supported the euro slightly. But Mario Draghi, while he didn't give too much away.
He never does.
He never does. Well, he didn't give too much away in his press conference because he wants to preserve his freedom of movement. But if we get some weaker numbers from the eurozone, you could start to see, I think, the euro moving lower against the US dollar on expectations that the ECB will do something. We don't know what they'll do, where are they targeting it, or how much they'll do each month. But it is still a possibility that it will move later in the year. So we could see that putting significant downward pressure on the euro. It's held 110 against the dollar really all the way through this week. You can see on the chart, and that's a big support level there that has been holding, in fact, all the way since the Brexit vote. If we do sort of go through there, you get a sort of trapdoor moment, or you could get a trapdoor moment that could see it pushing down to more, maybe 108 against the US dollar. That's the sort of level we saw back in March of this year. So that's probably the one to watch on the downside. I think there's a sense of waiting to see what those eurozone numbers will be. We get a lot of German confidence data next week as well, which could have a big bearing on the euro too.
Staying with interest rate decisions, the big one for next week is the Bank of Japan. Now, a lot of people would say that this has pretty much already been baked into the cake, as it were, because we are expecting stimulus.
Of what kind? We're not quite sure. That's the big question. Now, of course, Kuroda yesterday ruled out the idea of helicopter money, which is, well, you can have helicopter money of different kinds. Either you give people money directly or you issue perpetual bonds. It's a sort of complex monetary policy question. But certainly with the re-election of Prime Minister Shinzo Abe, essentially the Bank of Japan and Japanese government have been given a lot more wiggle room, if you like, to try some new unconventional policy measures. Now, they disappointed the market earlier in the year when they didn't move, and I think it's about time they started to, because they cut their forecast for price inflation later in the year. So that clearly shows that Japan still battling with inflation after so many years. In terms of the chart, what we've got is the long-term downtrend here. Since the beginning of the year, the dollar against the yen has been steadily tracking lower. We've had another one of these, what you might call a sellable bounce. It's rallied strongly off the lows of July, but over the last couple of days, it seems to have run out of steam, particularly around that blue line there. That's the 50-day moving average. And then the black trend line that I've put on there also sort of indicates the general direction of travel. And every time we get up to this kind of area, it tends to sell off. So you might start to see a bit more weakness for the US dollar as we head into next week. If the Bank of Japan doesn't move, that would put a lot more pressure on this pair to move lower, particularly as the yen starts to strengthen.
OK, Chris. And of course, we've got on Wednesday the Federal Reserve interest rate decision as well. So that's something else we're watching. But in the meantime, we're going to march on and talk about the corporate data, because I'm going to have to take a deep breath right now because there is a lot. There's tons to look out for. OK, so as we can see it there, Monday, we start with food manufacturer Cranwick. We've got insurance provider there, Hiscox. Ryanair, after rival EasyJet reported disappointing earnings and spoke of the pressures in the sector, reduced sterling, terrorism fears, various strikes as well. And all of these factors are playing into that industry. Let's move on to Tuesday, because we've got some really big companies. We've got BP, Apple, Twitter on there, and McDonald's too. On Wednesday, it's another big day for the blue chips. We've got Facebook, Coca-Cola, ITV, Airbus and Nintendo. I want to talk about this one because the worldwide phenomenon that is Pokemon, which added $20 billion to the market value of Nintendo. Now, this app is now officially available in Japan. That's where it all started. It's been taking the world by storm for the last 2 weeks or so it's back in Japan. All right, moving on. On Thursday, we've got Sky, Lloyds, BT, Alphabet, Amazon, Shell. So we've got the financials, the tech giants, the energy stocks, and really everything else in between. On Friday, we have another British bank to make up the week there. We've got another energy giant, ExxonMobil. We've got Swiss Bank as well, UBS there. And all throughout next week, I will be running through all of these companies in more detail. But for the meantime, we're going to get focused and we're going to stick to three just now. Let's have a look at what we're going to talk about just now. So first on the list, Apple. My goodness me, what a company to talk about, Chris. I mean, it's actually been quite a painful year so far, though, hasn't it, for Apple? Still the most valuable company in the world.
Yes, just about, I think. Questions over Apple really concern where iPhone growth is coming from, because that's been the big driver of Apple shares over the last few years. It was the company really that could do no wrong in the sense of its outlook. Really, they continue to be very, very popular. But if we do see further weakening for Apple shares, then there could be concerns that actually there's a lot more downside to come. Now, where's the big good news coming from? We don't know, because we really haven't had much in the way of product launches.
We need something exciting.
That's been what's driving Apple shares the last few years, and the China growth story has started to sort of slow a bit as well. So that's why, if you look at an Apple chart, it's not actually very encouraging, really. It's quite a depressing chart. You can see this is back to the beginning of 2015 or so, and since we hit that sort of 135 all-time high in 2015, we've then started to decline. In fact, that's become more precipitous as time has gone on. So within the context of a declining trend, the big bounce in Apple shares over the last 2 or 3 weeks has started to run out of steam. If we zoom in, we can see that in more detail there. So you might think that there might be more downside ahead, particularly if earnings do disappoint, and if they issue, shall we say, cautious guidance for the coming quarter. You can see a catalyst for why Apple shares might continue to explore the downside, in which case we're looking at them going back maybe to $92.50, or indeed the May low at about $89.40. So it could be quite a key earnings report for Apple.
And we need another product to get everybody talking again, because I think since the iPhone 6 we haven't been excited much at all about anything else. Right, let's talk about something not very exciting at all, the British banks, because they've had a terrible time since the Brexit decision, actually worse than the market itself, because the market has been demonstrating resilience but not the banks.
Yeah, the market itself has done very, very well since Brexit, but the banks, of course, a key play on the UK economy. They've been hit, obviously, by the uncertainty about Brexit, but also because the Bank of England now expected to loosen policy, cut interest rates, which will hit some of the banks' profitability. Now, the US banks have done better because the US economy is picking up. The concern is that the UK economy is going to be hit significantly by Brexit, and that you'll see a drop in demand for mortgages, in demand for other loans from business, and that really starts to make life very difficult for the banks. In terms of Lloyd's share price, you can see that we had this big gap down on the day of Brexit. We were up at about 72p a share the day before, and then when the market opened, we slumped, in fact, all the way down to about 51p. Since then, we recovered just a little bit to 54p, but we're well off the government's target sale price, which is north of 75p going to 80p, and it looks unlikely that we'll get anywhere near there for the time being. So at the moment, I'm inclined to say it looks like we're moving sort of into selling into strength mode for Lloyd's shares, and you could see a lot more downside. So it could be a very, very key set of earnings for Lloyd's as well. If they can issue a fairly robust update, because they're very strong in mortgages, then you might start to see a reason why the shares do recover. But I think anything signaling weakness suggests we'll head back to 50p and potentially below.
Okay, well, something that investors really do like, though, has to be Facebook. It's doing extremely well, going from strength to strength, and it's still managing to keep these users. 1.65 billion monthly users in the first quarter of 2016. That outshadows Twitter, LinkedIn. It just pales in comparison, doesn't it?
It does, really. And Facebook is in that sort of phase where the company can do no wrong with investors, which is sometimes a good thing. Other times it can be quite difficult to live up to expectations. But every time the quarter comes round, they do seem to recover and post a very strong growth story. So compared to the likes of Twitter, Facebook just continues to go from strength to strength, and user growth continues as well. So that's very, very strong. They're making money like there's no tomorrow as well, and expansion continues apace. So the chart is one of those, it's a sort of a sight to behold, really. You've seen very, very strong movement higher, and every dip, and there have been dips in the share price, but every time we do see those, and usually it means they get back to the 200-day moving average. That's that rising red line on the chart there. Every time it gets down to there, buyers seem to step in. So you can see at the moment the price up at about $120 a share is quite a way away from the 200-day moving average, which is about $110. So it might not be surprising, perhaps after the earnings, to see some of that given back and see that gap close. But I think people looking at this chart might want to wait for those kind of dips before they look at perhaps long positions in Facebook, because it's definitely been a very strong performer, and it makes sense to go with that rising trend.
All right, Chris, thank you very much. And actually, IG is on Facebook, so you can join us if you want to. And that's all from me and Chris today. To conclude, we are watching the Bank of Japan, the UK, eurozone GDP, the Fed, Facebook, Apple, British banks. There's a lot to contend ourselves with next week. It's going to be super busy. Thank you so much for watching, and have a fantastic weekend.